Hello, everybody. Welcome back. Jeff, thanks for being a guest on the show today.
Morning, Alison. Thanks for having me.
Yeah. So, it's a beautiful spring day. Maybe people can't see that. Well, they probably will. I'm going to have to probably move my camera at some point because the sun's going to hit me. But point is, it's the spring, and in my experience, people tend to come out of the woodwork now to start thinking about buying a home. I'm interested to see if I get a bunch of calls today, actually, because it's absolutely gorgeous out. I tend to see that first time buyers come out kind of a lot at this time of year. And I wanted to have you on to talk about co-ops today because every single time I start working with a new buyer, I will inevitably get them sending me a listing, which looks like a really good price. And they send it to me, and it might be a great unit, and the price might actually be good. We'll get to kind of pricing in a few minutes, but it's a co-op. And I have to explain to them, well, this is a co-op. Do you know what that means? And sometimes they have an idea, and sometimes they have no idea whatsoever. So, in light of the fact that we have people who might be actually getting into the market and fairly uneducated about this, I wanted to bring you on to talk about what co-ops are, how they work, how the financing works, and go from there. So thanks for coming on again.
Sure.
And just so people know, you've been doing co-op loans on and off for a couple decades now. And so you definitely understand the process. And so, you're an excellent resource about this stuff.
Great.
Yeah. All right, so this is a brief history just so people know, because I found this interesting. So as I was researching, and a lot of this information is from Edmund J. Flynn, which anybody who's involved in a co-op will probably end up hearing their name, end up working with them, because they are the co-op specialists in this area. And they are composed of attorneys who specialize in co-op transactions, can answer any of the legal questions that might come up, can just generally guide you through the process, and will actually be the ones typically who do the closing for you as well. But so anyway, I found out that in 1920, several rental buildings in DC, they converted to co-op ownership. And since then, we've obviously had more converted. And the thing I found most interesting is that DC is second only to New York City in the concentration of co-ops in the country.
That's
right?
correct. Yeah, I mean, DC is a very big co-op market. I don't know the exact numbers. I would guess New York is probably 5 to 10 times more buildings, but it's obviously a huge metropolitan area. So DC, right, for big cities is actually still relatively small, but do have a lot of co-ops and have had for years. There's a few in Maryland. There's a couple in Virginia and Washington State for whatever reason. There's some out there, but DC is definitely one of the bigger co-op markets, or second biggest co-op market. One thing I wanted to comment on, you kind of gave it away that you're in the real estate business when you said it's a beautiful spring day when we're in early February. I feel like the spring market for real estate in DC has always started with Martin Luther King weekend, and almost every year it's like the phone just blows up starting that weekend for the spring. And this year was, even though the market's down a little bit, it seemed like really picked up a couple weeks ago. So.
Yeah, I tell all of my clients, I say, like, when are things going to pick up? And I say the first really warm day we have in winter is typically when people start, sometimes the crocuses start coming up, people start thinking about spring, and any kind of marketing that's happening in the world that's will like really let go into the spring stuff, right? And so part of that is just buying a home. Anyway, okay, so obviously I think what we need to start with is explaining what a co-op is to people. And I will just very quickly say that a lot of this does come down to like legalese and kind of the legal entities and in part how the contracts are written. So clearly neither of us are attorneys, and we can kind of speak in, the generalities that frankly a buyer really needs to know, right?
Correct.
So maybe you can kind of kick us off and
Sure.
tell us what a co-op is.
So the way I always explain the difference between a condo and a co-op, or single family and a co-op, condos and single families, ownership is more or less the same. People have an individual title to that property. They own that property. It shows up on public records that they're the owner. And co-ops are different. Co-ops, when you're buying a co-op, you're basically buying into a corporation, is the way I always explain it. You're buying stock into a company, just like you would buy in the Microsoft or a company, whatever. Not to plug Microsoft. Anyway, some co-ops actually even give out stock certificates. Not all of them do, but some do, and they give you your certain amount of shares. And for your shares, you get to use your co-op unit as your residence. So that's really the main difference. It's again, you're right. There's a lot of legal parts to it, but as far as the consumer is concerned, that's what their biggest thing is going to be. Is they don't have an individual title on a property. They're buying into a business, and that business it owns the building. And even when you look up the tax bill for a co-op, it's in the name of the co-op property, and it might be for $500,000 or something like that, because they tax the whole building as one versus individual units like you would for a condo.
Yep, exactly. So, I mean, obviously, from a user standpoint, you have the ability to live in and use the space within your, let's just say, four walls or more walls. So from a practical living standpoint,
No difference.
It's the same.
Correct.
It's the same.
Exactly the same.
So yeah. So I mean, again, and it depends on the specific condo, but co-ops almost always cover, just when we're going to get to the fees, but they cover a broader number of amenities and things that they cover, in my experience. But again, that does differ depending on the building and the bylaws and all that kind of stuff.
I can't recall ever seeing a co-op that didn't include utilities in the monthly fee. I definitely have seen condos over the years where utilities are not included. Generally, those have a lot smaller fees. But co-ops, I'm not aware of any. I think partly because, again, it's a corporation. The company goes and they get the electric bill, they get the water bill. So it's generally in there. And if you're buying a co-op, when you get your resale documents that show all the legal information about the condo or co-op, they'll give you a budget, and you can see exactly what they're paying every month or every year for water, electricity, all that stuff.
Right. So, I mean, to go through some other kind of differences or similarities between them, I can kind of speak to this, and feel free to interject when you want. So there is a board that exists for both, right? And you can try to be on the board of a condo or a co-op association, and they're going to have their own rules about how you would get on and how long you would serve and all of that. Another main difference, like we were talking about, is how everything is financing wise with the co-op is done as one corporation, as one building, if you will, if you want to think of it in that way. And a main difference is that a co-op can take out another loan. So they can take what's called a blanket loan. So if you had a huge building, a huge co-op building that, say, had to do roof replacement, you have three options. You can use your reserves, which you get access to the financials, obviously, when you're getting involved in a co-op. You can do a special assessment, which means, you might pay one lump sum, you might pay X amount per month over the course of, 12, 24 months, whatever. And that might not be an insignificant number, could hundreds of dollars potentially per month. I think you were telling me offline that your sister had a $800 a month special assessment in a condo.
She did. And she had to do they had to do repairs or replace a bunch of balconies. She didn't even have a balcony in her condo, but she still had to pay, and it was like $850 a month for 18 months or something like that.
Right.
But a condo, it's a much more difficult process for a condo to take a loan. Where a co-op, because again, it's a business, they can get an underlying mortgage or a corporate mortgage or whatever you want to call it, a loan that the building can take. Everybody pays their share of it, but because they can spread it over a longer time, a lot of times it's a lot cheaper than a special assessment for similar work.
Right. Right. And so, and again, a lot of this ends up being cyclical. We'll kind of bring things back in, but you have access to understanding the underlying initial mortgage amount versus if they took out another loan along the way. But yeah, so that was the third thing I was saying you could do. You could do a special assessment, you can do using money from your reserves, or you can take out the loan, and you can take out the loan fairly easily, which again, you did kind of say that that condos can potentially take out loans, but it's just a much more complicated
I've only
transaction.
seen it a few times over the years.
Me too.
When we see a budget, every now and then you see a loan payment, but it's usually a much lower amount. I don't think they're going out and getting $1 million mortgage to do, if you had to do really big stuff like, to redo the facade, redo the roof, whatever. Condos, generally, if you have some big job like that, as you said, you could pull from reserves, but that's not, they can't just pull from reserves and then not replenish those reserves. So generally, there's going to be some form of assessment to replenish that money.
Money is money. I mean, the money, if the money's going out, the money's got to go back in.
Exactly.
So, unfortunately, that's just how it works. So yeah, so we're kind of starting to get into pros and cons of co-ops, and Edmund J. Flynn does I think a really good job of ironing out and explaining what those things are and how a lot of the cons are kind of perceived. It really, I think it comes down to your understanding of co-ops. If you don't understand them, you tend to think that there's more negatives than positives. But so, one of the things you mentioned when we were talking offline that is a huge benefit are the closing costs and the low. I mean, there's a lower buying price, right? We just talked about somebody who sends me a $300,000 condo or sorry, co-op, and then the fees might be $1,000 a month. The fees are obviously higher per month, but the buying price is lower, and then the closing prices are lower. Do you want to kind of speak to that a little bit?
Sure. And one of the things that right now I feel like our people have been inquiring about co-ops much more in the last year than we have previously. Part of that is, as you were saying, some of the prices are lower. With interest rates being higher, people have a lot less buying power. Everybody got a little spoiled through COVID with the 2 and 3% interest rates that were great for everybody could get them at the time, but that's obviously not the case now. Rates are into the 5s and 6s. They even got into the 7s for a little while back in the fall, but thankfully have dropped back down. But anyway, having the buying power is very different than it was. So if you can buy a lesser priced build or unit, with the rates being the same between a condo and co-op, I'll get into the differences with that in a bit. But with them, if rates being the same, again, you might be able to get a cheaper payment with the co-op, even though the fees may be higher. Again, with the other part with co-ops, the co-op fee generally includes property taxes and a blanket insurance policy for the building. Condos, that's not the case. Condos, because you have title individually, the unit's taxed individually, you pay those taxes yourself every month with your payment, versus the co-op where it's included in that fee. So sometimes the fees seem a lot higher, and that's definitely one of the perceived negatives that you talked about, but it's not always reality because there is sometimes more to it.
Right. So another pro that I would say is you really have minimal responsibility. And from that, like when you own a property outright, you're fully responsible for the maintenance and repairs, and you can take more of a back seat with co-ops. Now, I mean, with co-ops still with what's in some of what's within your four walls, if not a lot, is still your responsibility to maintain and take care of. But generally speaking, it is a more hands-off kind of living situation. Like I tend to see more regular maintenance that's scheduled on your behalf, things like that. So whether or not the cost is kind of how the cost works out, like you have these things typically all ironed out from you. I find this to be a huge benefit in DC because generally speaking, we have a really big working population. People are very busy,
right.
And it's like that in a lot of cities, but so a lot of people aren't interested in home care.
Right.
They don't have the time for it, or they don't feel like it speaks to their strengths. So, you can have somebody or an entity or, a board or whatever, excuse me, who kind of helps you maintain that stuff.
Right. One of the other things with perceived negatives, since we were talking about that a couple minutes ago, is the board approval. That's one of the, and I know I'm kind of getting ahead of myself with differentiating between the two, but I figured that's definitely one of the negatives. That's the thing I hear people kind of, groan about the most, is that they have to go through this board approval process. They're really different amongst all of the co-ops. Some are essentially like a rubber stamp. You apply, you give them the paperwork, they say, okay, great. Most have some form of an interview process. There's a couple that when I say they do a mini mortgage application, they ask us to give copies of their credit report, the appraisal, bank statements, pay stubs, basically everything that we look at. So, which is an interesting scenario because you have people living in your building that literally know everything about your finances, which is not how condos work for sure, or any other situation. So those board approvals, some of them are a little bit more intrusive than others. Over the years, I've had a few issues. I think I mentioned this to you when we spoke earlier. I've had a few times where customers were rejected for various reasons, which one was, I think I told you the story, was a masseuse, and she wanted to run her business out of the building, and they rejected her because they didn't want strangers coming in and out of the building. Not unreasonable, but not something that she had thought about. I had other people back out themselves because of they had a dog that wasn't acceptable, or things like that. So there are a lot of things that co-op boards look at and ask about. Some co-op boards have their own financing requirements. They're different than ours. Some are really strict with qualifying ratios. Again, not to bog you down on boring mortgage stuff, but qualifying ratio is basically a ratio of your mortgage payment and your debts relative to your income. And sometimes the buildings, like there's one building that has a 33 ratio. We can go up to 45, sometimes even 50% of someone's income. They say 33, much, much more conservative. So that's somewhat of a negative, that it can make it a little bit more difficult. In the same token, one of the positives about co-ops, more so than condos, I think, because they do have this second level of review, they have another group of people looking at their qualifications, that co-op delinquencies are extremely low, especially in the DC area. We almost never see buildings that have high delinquencies, where condos, so every now and then you run into one that's 30, 40% delinquent on their fees. It makes it really hard to get a mortgage. Long term, it's bad for the health of the condo because of their finances. So even though it's a kind of perceived negative that these things exist and the boards look at all this stuff, the net positive is the default rate is much, much lower on co-ops. And the borrowers, I've noticed, just anecdotally tend to be very well qualified, usually have really good credit and money to work with as well. So.
Yeah, I mean, obviously it does depend on the building. And offline, you and I talked about how I've been very lucky in that the co-ops I've worked with on the deals have been very successful. We haven't had many issues, but I did do one in the Watergate where they scrutinized literally every single thing that my buyers went through.
Right.
So, and the thing is, I'm really uninvolved. The realtors and uninvolved in a lot of that. It is between the board and the buyers. But of course, I hear about what's happening, and
right.
One might say it's a little bit aggressive. But at the end of the day, like, you end up knowing your neighbors, maybe too much about your neighbors, but you're kind of all on the same. You're on the same kind of playing field,
right.
if you will. Like you have access to that.
Yeah, I mean, you're definitely. It's more.
At least when you're applying.
I think it's a. Again, this is not based on anything factual, but it's probably a little bit more of a community in the sense that, before you even start, you're going to meet a handful of people and talk to them, and they're going to ask you a bunch of questions. I have no idea what they ask in those board interviews, but I'm assuming some personal, some financial. But nonetheless, you get to know some people, and you get to know the players in the building as well. So
it's totally true.
Condo, you can move in and not know anybody if you live there 10 years.
Absolutely. I mean, when we moved into our condo, the one I've been in for 5 years now, we actually had a get together for our neighbors when we moved in, because we wanted to make sure that we had a relationship with them. And I think I'm pretty sure one of them said, "Oh, no one's ever done this before." And I was like, "How do you?"
That's crazy, right?
We share walls. Like, how do you not want to at least initially have a nice meeting, not like, "Hey, welcome to the building, the roof's falling off,"
Right.
like you'd prefer to have some kind of relationship.
We definitely get a lot of referrals from people that I'm trying, not as much now because people aren't refinancing, but for the last couple of years as people were refinancing, we got a lot of referrals from somebody that said, "Hey, I live in the building with so-and-so you did a loan for," and they asked me to get in touch with you to talk to you about a refinance. Again, I don't feel like we get that as much in condos, but I feel like it happens a lot in co-ops. Again, I just think the board is much more active. I think the community, the homeowner association is much more active where they do stuff together. And you just get to meet people and are a little bit more involved.
Yeah, agreed. Okay, so a couple more of kind of the pros and cons, depending on how you believe it. So the high monthly fees, are they really that much higher? I would say it ends up being a wash a lot of the time. And you're going to give us an example at the end, which I think is really awesome for people to hear. So we'll kind of save that. So the two cons I hear the most, aside from the high fees, which we can kind of knock off pretty easily, is the restrictions. And part of that does kind of go into the interview process, as in you can have people be, they might not make it through the interview process, or that's a restriction. It can be a restriction. And also, there are going to be, in my experience, there are sometimes more stringent rules on renting, on pets and things like that. It's harder again, in my experience with what I've seen, to change those bylaws, and you know, and get those things changed, or addressed. So restrictions are really important to pay attention to, frankly, for any purchase, I would say.
Any
But
communal living place for sure, if a condo or co-op,
any
they
right,
all have rules with that. The condos
right,
generally, and this is something that comes up a lot if we're doing a VA loan, which we can't do on co-ops, but for condos, if you're doing a VA loan, one of the things we have to look for is rent restrictions. So I've read through hundreds of bylaws over the years, and almost none of them have rent restrictions. Co-ops, different story. A lot of the buildings do limit the financing side on. For us, a co-op can't have more than 50% renters, which again is a perceived negative. If you plan on buying it, I mean, if you're buying a co-op and you want to keep it as a long-term investment property, that's probably not the right property to buy, because the co-ops are different. A lot of them, even though they may let you rent, sometimes they say you can only rent for 2 out of 3 years. So you can't keep it like forever as a rental, which is much different than a condo. But at the same time, even though that's negative, there's a reason that those rules exist.
yeah,
And there's a reason that Fannie Mae and Freddie Mac, the people that write all the rules for mortgages, care about that, is that if buildings get too heavy with investors, they tend to have more delinquencies and more problems and are just less financially healthy. So long term, it's better for you that those rules exist. You may not think it at the time, but the reality is that that's why they exist. Is it does keep the building much more financially stable, because people pay their mortgages more often on primary residences than they do on investors.
Yeah. Okay, so before we kind of get into the buying process, which is obviously one of the most important things I'm going to talk about, it's people think that there's less liquidity with condos, that they're harder to sell, that you're not going to make as much money. And I mean, at the end of the day, because the purchase and sales price is a little bit lower, you're not going to the values are not going to go up to the same degree as, say, a condo or a single family house would. But we've talked about the pros, so that might just offset that for you from a personal standpoint.
One note on that: with co-ops, the closing costs are a lot less expensive, which makes buying and sell, well, more buying than selling, but buying less expensive upfront with money that, frankly, you just don't get back. There's no owner's or lender's title insurance, which is thousands of dollars difference on a similar price condo. That you don't have to. There's no tax proration where you have to credit back the seller for taxes they've already paid. Depending on time of year, it could be hundreds. It could be lower thousands for that. And then they also don't have title search fees because there's not really a title for the property. So that's a big difference. In Maryland, there's actually no transfer taxes, which is very different. That's not the case in DC, but Maryland, there's no transfer taxes. So the closing costs, if you buy one of the few co-ops in Maryland, it's significantly less expensive, thousands and thousands. Yeah. But again, that could make it a lot easier of a starter home for somebody. And if you turn around and sell it in 2 or 3 years, you don't have as much time to have to recoup the lost costs with the closing costs. So I don't know if I can really speak to with any authority on how the prices change. You probably would know that better than me. Again, anecdotally, I've heard that they move slower up and down, but you'd know better than I would on that.
Yeah, and I mean, some people say that you have a smaller buyer pool, but I think a lot of that does come down to education and people understanding what they are and what it means, and the pros and the cons, and et cetera, et cetera. So
that goes for agents too, by the way. With not just buyers. I quite often have agents that call me because our name's on one of the approved lender lists at the co-op, and they've never dealt with a co-op before and don't have a lot of familiarity with it. And from an agent perspective,
how do you educate people on it if you don't understand it?
And how do you sell it if you don't understand it, correct? Like how, if you're looking at places, apartments for people, or looking at condos, and a co-op pops up and you've never sold one before and you don't really understand it, you may not even show it to them, right? Because it may not be something you're familiar with or whatever. So it is good to educate everybody on it, because it can be a really great way to get your foot in the market, especially if you're a younger, first-time homebuyer, doesn't have a whole lot of money. Most buildings we can do 5% down. Where there are some co-ops that require 10 and 20, but the majority of them 5% you can do, and since the closing costs are less, it is more manageable.
Yeah. All right. Well, I think we can kind of just kind of end with explaining how the financing differs from co-ops to condos. Obviously, this is kind of this is your wheelhouse. So you can explain. Well, before you explain it, I want to say that something I've experienced from the lending perspective is that not all lenders actually do loans for co-ops, and so the first thing I say when I meet with people is I understand what they want, what their timeline is, and then I ask them if they have a lender. And I encourage them to develop a relationship with a lender so that when they're ready to jump, because this market's crazy and you might have to jump quickly, that they already have everything kind of ready. But the fact is, if you're considering co-ops, you might have to switch if your lender is not somebody who works with them. And I will say a lot of lenders in this area don't.
That's correct. There are a handful of companies, a couple bigger banks, and then a couple of smaller companies. Caliber is kind of big and small at the same time. And we're one of the largest lenders in the company, but we do everything locally. Like I do everything in my office. All our underwriters are here. I live in the area, work in the area for 25 years. So we're big and small at the same time. But anyway, with co-ops, we do quite often have people that come to us and have already been pre-approved. We're looking at condos. The co-op that we're interested in came up, and they have to switch lenders and restart the whole process. Have a new credit report run. Give another stranger your financial information, your pay stubs, your bank statements, W-2s, all that kind of stuff. So it does happen quite often. Good news is, again, I'll plug myself a little bit. If you come to me in the beginning, we can do condos, co-ops, or single family. And we go Maryland, Virginia, DC, so you can cross over and not have to like reapply if you end up buying a co-op. So that is definitely one of the things is there's not quite as many lenders that do it. And it's good to, if at all thinking about co-ops, to be pre-approved by somebody that can do both. As far as the differences of the financing, I touched on the down payment requirements that the co-ops have. Assuming the co-ops don't have any different financing requirements, it defaults to 5% down. There are some scenarios where we can do condos with 3% down, so there's an extra 2% minimum that you have to put down on a co-op versus a condo. But outside of that, the financing is very, very similar. There's not a whole lot of differences. We qualify all the same way. The loan process is more or less the same. We ask for the same documentation, credit standards, all of that stuff is identical. Only real difference is with interest rates. If you are putting less than 25% down on a condominium, Fannie Mae and Freddie Mac charge a premium that makes the interest rate anywhere from 1/4 to 0.5% higher. With co-ops, they don't charge that. I've never gotten a complete clear answer on why that is, but I'm assuming it's because condos have a higher default rate than co-ops do. We kind of touched on that earlier, that there are more, the co-op has their own standards, and because of that, their default rate's a lot lower. So that premium doesn't get charged on condos. So if you are doing a lower down payment, less than 25%, there are, the condo definitely can have a higher rate than a co-op, all things being equal. Otherwise, though, the financing process, everything is more or less the same. Timing-wise, it usually does take a little bit longer for three reasons really. As you said, there's only a few title companies that do them. EJ Flynn's the big one, Monarch Title as well, because they're the only ones. They're busy all the time, title may take a little bit longer to come back with them just because of the volume. Secondly, the appraisers take a little bit longer because they have to get a lot more information than they normally would for a condominium.
Right.
And then there obviously the board approval process. Some of the boards meet every couple weeks, some only meet once a month, so that has to be done prior to closing because they have to get that board approval. The title company requires it, we require seeing a copy of it, and the board requires it before you can close. So that can push the time out a little. And then the last thing, the one thing that really does separate the two that is significant is the co-op building approvals that we do. We look at every building. Condominiums, if you're putting 10% or more down, in most cases, it's a pretty streamlined process. If you put less than 10%, we have to get budget and a few different things. With co-ops, on every co-op, we have to get 2 years of their financials that have been audited. We have to get a budget. We have to get a questionnaire. We get a pretty healthy stack of paperwork that has to be reviewed. A lot of the buildings we have approved already, so we're just updating and not doing a full approval every time. But it is a fair amount of paperwork that we have to get together, and sometimes it's pretty involved. Again, the net is that we're looking at the health of the building and the financial well-being of the building and really looking out obviously for ourselves, but we're looking out for the customer who, my guess is most people when they get condo and co-op resale packages glance at it and don't really dig too deep. We do have people that call and ask really specific questions, but most people just, they probably look at it and figure it's fine and whatever. But with co-ops, we get pretty far into that. So that's the biggest differentiator between the two. It is much more involved of a process.
Yeah, and really quick, because we're going a little long on this episode, but
I talk a lot.
right in the beginning, I think it was me this time, but you in the beginning kind of gave me an example of the difference in payment for somebody. So, I mean, I guess a good way to conclude this episode is telling people that, we talked about how the high, I'm putting in quotes, monthly fees make it seem like maybe you're going to be paying a lot more for a co-op. But really, in the example you gave me, if you want to quickly tell people, I mean,
sure, I have some notes.
Came out about the same.
If I'm looking away, I want to make sure I'm giving the right numbers. So I had a person just this past weekend call me about the Capitol Hill Towers co-op. It's a newer building. I want to say it was built in 2006 or something like that. Most co-ops are 100-plus-year-old buildings. This one is newer. They have a pretty significant underlying mortgage. In this case, for his unit, the sales price is $375, and the underlying mortgage allocated for his unit's $95,000, which again sounds like a lot, and you think, oh well, that's not necessarily great. But where it helps is that underlying mortgage, they have like a 2.75% interest rate on it. So $95,000 that the borrower is essentially borrowing for that underlying mortgage for their unit is at a much lower rate than where rates are today. So that helps with the payment a bit. The way that works is the underlying mortgage stays with the unit. So when you buy or sell a co-op, it gets paid just like any other mortgage. There's principal and interest every month, and the balance goes down every month as you pay it down. As part of that co-op fee. That balance, when you go to closing, the title company will verify, EJ Flynn or Monarch or whoever, will verify a couple days before settlement the exact amount of the underlying mortgage at closing. And that basically goes on the seller side and the buyer side of the settlement statement, and it basically transfers from the seller to the buyer. Again, in this case, they're transferring at 2.75% rate. So in this case, the sales price was $375. The buyer was putting $100,000 down. He was lucky he had a lot of money to work with. So I ran the numbers. With that underlying mortgage, the fee there is $955, which for a $375,000 unit, you'd say, oh, that's really high. But his total mortgage payment was $2,075. I ran the numbers for a condo he was looking at in Virginia. The taxes for that were $351 a month, and the fee was $469 a month. So when I ran the numbers, and there was no underlying mortgage on that because it's a condo, so he had to finance that extra $95,000 with the higher rate. The payment on that one ended up being $2,540. So it was almost $500 cheaper for the co-op, even though that fee is really high. So that's real numbers. It doesn't always work that way, but that was a real example from somebody I talked to just a couple days ago. And now he's mulling over does he want to move to the burbs or does he want to buy this place in D.C.? That I can't help with, but the numbers I can. So.
Right. Well, I mean, and I think that to bring us completely full circle, as the market is heating up and rates are still higher than they were a year ago, we'll have people say, they're historically still not that high, blah, blah. But as you're trying to compare what to get right now might not be a bad time for you to consider the co-op because of the underlying mortgage that may have an insanely low rate.
Right. And not all buildings have underlying mortgages. There's a lot in DC that don't. Yeah. But this particular one has a larger one. But that again, it's something I think more of the confusion that people don't understand it. One last thing I wanted to touch on. I'm sorry difference in the financing is the way we calculate the mortgage amount when you're buying a co-op. When you are getting a condo, let's make the math easy. If it was a $400,000 sales price and you're putting $100,000 down, you're borrowing $300,000. If you have a co-op that has a $100,000 underlying mortgage and a $400,000 price, we take the $400,000, we subtract the underlying mortgage, and then we figure out your down payment from that. And in that case, you'd only borrow $200,000. So where that really matters is if you're looking at to do a minimum down, you're trying to do 5% down. 5% is usually cheaper if there's an underlying mortgage for co-op than it would be for a similar price condo because of that factoring in that underlying mortgage.
Yeah. Well, Jeff, thank you. You are a wealth of knowledge when it comes to this, and I will be linking your information in the show notes. I mean, if people are interested in just even talking about this with you, and I will say just real quickly, I haven't worked with you before, but you were recommended from a colleague, a lender who's been on the show many times before. So, if people have started working with somebody else and they're interested in a co-op, it doesn't mean you don't have options, right?
Definitely.
So keep that in mind.
Yep.
Well, thank you so much. And we will talk to you
Great.
soon, Jeff.
Thanks, Allison. Thanks for having me.
Okay. No problem.
See you later.